G'day, Money Miners. Another bloody huge deal, JD. You're bringing
a massive one.
And what was I supposed to say again?
Well, JD's got a $5 billion gold tie-up in Canada.
US, the big real billions.
I'm going into the monopoly in the cesium market, and it has some implications. There's some juniors out there that are having some wins off the back of a discovery. But I'm going to go into that whole market, which monopolies are awesome, mate. They're very cool and rare in our industry. They don't have it very often, so I'm going to go
into it. True. And another big gold deal closer to home.
Talk about this could be creating a Kalgoorlie monopoly. Not really, but
if you can fit
if you're talking monopoly, yours might be a Mayfair. This is more a
what are the cheap
Old
shit?
Kent Road, possibly. Righto, take it away. Equinox Calibre tie-up.
All right, we're going to North America for this one. This is a America's focused deal, and there was pretty mixed reactions to it. So share price on the Equinox side, they're the bigger party. You know, they kind of call it a merger, call it whatever you like, but they're really taking out the other party, Calibre, in an all-scrip deal. They were flat, and Calibre's share price was in for a bit of a rough ride. They ended up peeling off 7%. Shareholders weren't all too chuffed.
Mate, I saw a lot of posts on Twitter kind of right after this came out, and not a single post was there a happy shareholder on either side.
Yeah, so negative reaction on both sides. Of course, sort of, Twitter can be a bit anecdotal. You want to piece it together with every sort of bit of info you can find. But I mean, just looking at the share price, right? People aren't happy with how it's sort of gone about, especially if you're Calibre, because really it's a nil premium, or if you want to be generous, a 2% premium takeout. So we'll get into it. There's a few interesting slides in the pack that they put out. Equinox shareholders have a pretty well-known chair. For Aussie listeners to the show, Ross Beatty is the chair of Equinox, very well-known in Canadian mining circles. And the stock has been on an up and down ride over the last few years. So they put this little chart in the deck that they put out, and I think it's a little bit cheeky because you can see on the y-axis there, they're talking about market cap. Now, if you actually look at the share price, it's not quite as flattering because, the crux of the story is that they've had to dilute to be on this growth journey that they're on to finance the development of a lot of projects. We've spoken about Greenstone. That's their big project. I think, Matty, it was you and I speaking about when they consolidated ownership there. They took the other 40% that had been with Orion Mine Finance, grouped it all together so they were the 100% owner of that asset.
Before that, Gold Road were rumoured to be pretty advanced, trying to pick that share up.
That's right.
Yeah, I remember that.
Another group of shareholders that weren't too happy with a potential deal in that case. On the Calibre side of things, you've got a company that's grown from an explorer not all that long ago. So if you go back just to 2019, they're an explorer, and through the sequence of doing a number of deals, they've become a pretty handy-sized miner. So this deal sort of puts their market cap at Canadian 2.6 billion, or I think US about 1.7. They've got 3 producing assets now, and Valentine is their big growth project. That's meant to pour first gold in Q2 of this calendar year. So pretty imminent on that front, 195,000 ounces per annum at the initial sort of phase, and doing studies to scale that one up.
I like Trading View, highly compliments to the change of colour scale there on the lines. Is that
it's a funky one, hey?
That's bloody, I don't know. I'm like, is that my eyes? Anyway, cool. Just adds that extra layer to a stock going up or down. Right.
So let's talk about the details around the deal, because myself and I'm sure a bunch of the Aussie listeners won't be all that familiar with the assets that we're talking about here. But as a combined group, if the deal goes through, you've got 9 producing mines and a mine under construction, the one I just mentioned in Valentine. There's question marks around Equinox's Los Filos. That's not really factored into any of the production assumptions going forward because there's community-related challenges that they're experiencing there in Mexico. You've got a 10-person board to start with, chaired by Ross Beatty. I'd expect that to be trimmed down once the deal is sort of bedded down. And I also expect there to be a bit of rationalisation of the smaller high-cost assets in the portfolio there. With regard to the deal itself, how it's kind of been structured, I think the nil premium aspect is the logical starting point. I mean, hey, it's awesome if you're sort of Equinox, taking that point of view, and you're happy with everything else, great getting a company at a nil premium. That's awesome. But there's always a bit more to it. The details are that Calibre shareholders will get 0.31 Equinox shares per share that they hold. So the pro forma ownership will be 65% Equinox, 35% CXB. That's Calibre, and standard sort of matching rights in the conditions of the deal, as well as needing a vote to go through. Similar to when we spoke about Karora, Westgold, Calibre shareholders need to get behind this deal to the tune of 66.6%. On the other side, Equinox also have to vote, but they just need a simple majority of shareholders to get that one over the line.
On to your point on the nil premium, I don't mind it. If they're gonna, like, this is a deal where you're gonna get to it, but there's no synergies. And if there's no synergies, I don't think it's particularly appropriate to pay a premium if you're not getting like the synergy value. So if you've got no synergies, nil premium, you're doing it for scale's sake, so you can get into an index and don't pay a premium, and that's where you go about it. I think that's more defensible than paying a premium, to be honest.
Yeah, no, 100%. I agree with you. That's pretty much what I'd written out over the next 5 minutes that I was going to chat through.
Sorry.
Why do they?
That's the crux of it. You search for synergies in the presentation, you get one hit, and it feels pretty obligatory for them to write it in there. But investors asked the question on the call as well. There's no asset synergies. You might get a few savings here and there on the corporate side of the business, but that is not why you're doing this deal.
Why do they have to vote both sides on this case, JD, where we only have to vote on one side over here?
It's a good question. I couldn't answer specifically. I'd imagine just because it's a massive deal sort of on both sides, a big use. You're issuing a substantial amount of capital. That's why Equinox has to. Kind of similar, I guess, if you're thinking about a massive capital raise, the company as well on that side of it, you need to get shareholder approval. That type of perspective. There was one feature of the deal itself which was interesting. I think it raised a few eyebrows. This sort of concurrent financing that they speak about. It's nothing new to see the target company get a bit of financing to see themselves through to completion. Calibre call it insurance, but the nature of it sort of stood out. So they're going to take in $75 million via unsecured convertible notes, 40 million of which is going to go to Equinox. They're going to just eliminate them, assuming the deal goes through. The remaining 35 will go to a couple of different groups, one being Westgold and the other being Trinity Capital Partners. Now, the terms of the con note are fairly standard, 5 years at a premium of 37.5%. But they don't actually mention in the presentation anywhere that there are warrants attached to this, or options if you're an Aussie. So you only see that in the announcement in the fine print that 0.66 warrants are going to be issued per convertible share. So
with a 5-year term, you're getting a really generous coupon in addition to the upside of that convertible, buoyant gold market with 5 years of volatility in your favour, and then the free warrant for every 0.66 con notes you own. Like, I'd say, where can I sign myself up for some of them?
Yeah, the way I kind of came to think about it is it is what it is, that the financiers, this always kind of happens one way or another. It's not unusual that we kind of see this. It's always a bit more than the terms that you read. There's always a bit more compensation going, and you've just got to, if you're the mining company, you've just got to pay the price. There's not too much you can kind of really do is the view that I've come to. I don't like that it's not included in the presentation. I think just kind of be upfront about it, show it. But I mean, it's quite a sort of.
It is unusual for it to like a working capital loan from the acquirer to the target. Not unusual. It is unusual for there to be other parties to that. Especially when one of those parties is the financial advisor to the acquisition.
I hear you in this specific case. I'm more sort of generalizing the point of these sorts of convertible notes. It does always seem like there's finer print, or if it's like a prepayment or something like that, there's always a bit more payment. The Mika deal, that one comes to mind, where you had to do a bit more unpacking on the gold loan type situation. Yeah, and at the end of the day, that is the kind of market rate. It's not like a straightforward percentage that you're just kind of paying, but that is the market rate, whether you kind of like it or not. And it's up to the company to try and get the most attractive terms. That's just their job to try and look after the interests of shareholders.
What do you think? What do you think of deal security, JD?
I think there's a small chance of an interloper coming in. So to start with, on the break fees, US 85 million to Equinox or 145 million to Calibre should the other party be in the deal. Given that there's, it's a nil premium, someone could kind of come in with a modest premium, but it's Canadian 2.6 billion. It's got assets in America, Canada, and Nicaragua. Given the scale and the appetite for that kind of portfolio of assets, I think there's a fairly limited number of other parties that would be attracted to that. There's also a bit of debt, which, I think minimises the interest for a few prospective buyers. So, despite the fact that we're in a gold bull market, I think there's a substantial focus on returns to shareholders, not blowing it on M&A, being disciplined, all these sorts of things. And I think if you sort of accumulate all of the above, what I've just kind of mentioned, I think there's limited, not no chance, but a sort of limited chance that somebody's going to have a swing.
You know what I wonder is if there's actually more appetite for the acquirer in this instance than there is for the target. Like, was Equinox actually a much more attractive target than Calibre, and hence path to survival is to, each not be eaten.
Yeah, interesting train of thought. I think the Greenstone and the Valentine assets, people would love those too. People would love one of those as well. If you could get both of them, that'd be awesome. But, one is with each of the parties, so a bit easier said than done.
They don't call it Valentine for nothing, JD. There's a lot of love there, mate.
A lot of love, mate. Let's kind of chat about the nature of this. We've, you mentioned synergies there, Trav. Like, trying to get into the mindset of Equinox and why you're doing this deal is an interesting thought process. And yeah, in large part, like you say, just to become a bigger company. Very simple. Prioritizing Canadian ounces, 50+% of the NAV is going to be in Canada. And Ross Beatty put it super succinctly on the call. We want to get big quick. It's that in a nutshell. I'll chuck up a chart here, which speaks to it. It's Matty, like we kind of joke about, it's a flow of funds game. The big get bigger. That's what they're targeting. And it reminded me of a bit of a meme that Ali chucked in the Director's Special newsletter a couple of weeks ago. So I'll kind of compare and contrast. One of them is saying the same thing in corporate speak. The other one is just in meme form. But for those listening to the podcast, you've got this slide where Equinox is showing all the constituent companies in the GDX and the GDXJ by market cap, and they group them. You've got 41 businesses that are in that $1 to $4 billion range. You've got 8 businesses in the $4 billion to $10 billion range. And beyond that, beyond $10 billion in market cap, you've got 7 companies. And what the meme just shows is that when investors come and they want to invest in gold, they look at gold, they look at the Gold Trust, they look at New York listed mega cap companies, and there's a very, very sort of little trickle down in capital to the juniors in the space. Hence the rationale for becoming a bigger company. And this issue I see being even more pronounced in North America than it is in Canada. I think the juniors in Canada and the smaller companies get even less love than they have been getting here in Australia.
Is that I know? Do you reckon they're paying a bit for Ross Beatty? He's like that name. Like, you play zero premium, but you get Ross Beatty.
That's the Canadian market, right? That you've got to have one of those names attached to it.
Like bloody Rick Rules always. Ross Beatty. He always talks about Lundins and Ross Beatty, and it's the brand that comes with it.
Yeah,
I think there's always value in that.
Yeah, we're susceptible to it in Australia. You got the Clarkey at Regis. You've got Raleigh. You got Bill. These guys attract a premium valuation, but it's like you're stapling it to the presentation in Canada. Like
you need a promoter in Canada.
Yeah. And
it's almost a necessary function of that market for some reason.
Yeah, Friedland probably another one we can mention there as well on the Canadian side of things. We've got to talk about the cheapness or the value of the deal. I think would be a bit remiss to not speak about it. They're not paying a premium, as I mentioned. That kind of helps. On CapIQ, you can see 9 analysts cover Calibre. They sort of peg the PNAV right now at 0.75 times. And there's development risk in that business. You sort of look at the group of peers. It's not totally out of place. you look at Equinox, they're trading at 0.73 times. So very, very similar ballpark, despite it being a bit of a bigger business and in a slightly different position, producing more ounces and all those sorts of things. But I think that just sort of hammers home that price is not why they're doing this deal.
So why are the shareholders pissed off, mate?
Mate, I'll try and summarise it from two different perspectives because you've got shareholders pissed off on both sides of the aisle here. And I'll just try and summarise their frustration as I kind of see it. On the Equinox side, you've got Greenstone, the big project, coming online. It's ramping up right now. And I think there was a sort of expectation amongst investors that this would come with a de-risking of the business. It would come with a deleveraging of the business as cash flow ramps up. And, that would come in tandem with a re-rate in the share price. So, tying that in with the view that the timing just wasn't right. Why not do this in future when you can get better bang for your buck? That ties in with the, a talking point on dilution. You got to do more dilution at this share price than if you were to re-rate. You're also getting exposure to places like Nicaragua. And if you're an investor, maybe that's not what you signed up for, maybe that's not why you're there. I understand that perspective. On the CXB side of things, the real frustration, the real question that you're asking as an investor is, why have you agreed to sell the company for no premium? You want that standard 30-35% premium if someone's going to take you out, which this kind of is at the end of the day. That's the big one people want answered. And maybe it is valid that the growth potential being combined with Equinox is maximized. Maybe it's better than if you're just going it solo. Valentine is, coming online this quarter or next quarter, as I sort of mentioned. Maybe the project risk is better handled in a bigger organization where you're sort of spreading that risk across more cash flows, more assets. So
you see that in the con note as well. Like there's for better or worse, there's a bit of a top-up financing going on there so that they don't have to dilute more in the future. They are there's a dilution effect from merging two businesses, but
yeah. So it's open-ended. We'll see as ramp-up goes on. We'll see if they do attract more generalists, more institutional investors, whether management is right in their judgment that this is the way to attract more capital and better, share price accretion.
Re-rate's an interesting one. It's like a recession. It's not like there's one day, this is all happening, we're having a re-rate right now. It's never an instantaneous thing, is it? Is it so when you're saying, probably for people that, the definition, like are you saying a re-rate, like saying we're going to outperform over a year, for instance, post this happening because the story's better once Greenstone come online, or like this re-rate thing isn't an instantaneous event, is it?
I think of a re-rate as multiple expansion. So maybe beforehand you were trading at like 3 times EBITDA. A year from now you're trading at 4 or 5 times EBITDA.
Yeah, better appreciation for what you've got.
Yeah,
kind of.
Just you go better in a year's time.
Yeah,
effectively.
Yeah, exactly.
It's like a recession. It's like there wasn't a recession. It's like it's a backward-looking thing.
Or maybe there was one back then.
Yeah, it wasn't
we're
like
all good
today.
now.
Holy shit, it's a recession today.
No, absolutely. So to put it all in a nutshell, if I'm going to give kind of my thoughts on the deal from a strategic angle, I get it. Growing the business in an absolute sense, index inclusion, trading liquidity, all that sort of stuff, low cost ounces in Canada, maybe trimming the portfolio in time, spreading the risk over more assets. So I understand that. On a value basis, I'm not quite there. You're paying in stock for a company that's trading at a kind of similar, maybe slightly richer multiple, not super earnings accretive if you're, looking into the details there. But in all honesty, the company is not trying to sell you on that. That's not how they're packaging up this deal. They're not talking about per share metrics whatsoever. It's all about getting bigger. It's all about being a leading Canadian gold miner. It's about increasing attractiveness to generalist investors, to big institutions. So from my perspective, I think it's a bit counterintuitive if you're coming from the lens of, a value investing orientation. It's not quite my style, but there's good odds it works. So we'll see if they are getting more bang for the buck, getting more value on the ounces they're producing, more value on the dollars they're earning in due course.
There you go. Go international.
That's it.
The bloody
Gold M&A.
YouTube's loving the international stories. They fucking love it. Right, next up, the cesium bolter. And I won't give any of them away.
There's a stock on the TSXV, gents, that has had a stellar run this year. It's Power Metals. It's up 213% year to date. I think if you look at it on a 1 year basis, it's up over 400%, which gives this little company a market cap of 212 million Canadian dollars at the time of recording. It's on the back of a discovery in a particularly niche commodity, which is cesium. Now, cesium is a commodity. I actually took a bit of interest in this commodity late last year because I met a fella who was telling me how Sinomine has a monopoly on the cesium market. And that got me really curious because monopolies are these beautiful but rare phenomenons in commodity markets. Where they can surface is in pretty niche minerals, which have a small market size, and cesium market fits that bill absolutely completely. This market is super opaque for what it's worth. So these numbers I'm about to throw out there are susceptible to being very wrong. And there's a lot of variation in the numbers you'll find when you're doing research on the size of this market. But for all intents and purposes, my research estimate of the size of the market, it's kind of being serviced by a mere 20,000 tons of cesium polysite ore. So I'm talking about the actual ore tons being mined, which that ore is processed into a variety of different midstream products. The main one or most popular one is cesium formate, which is actually a brine used in the oil and gas industry as a drilling fluid. But there's a bunch of other types of kind of midstream products, including cesium carbonate, cesium chloride, cesium nitrate, cesium hydroxide, cesium sulfate.
Is that a screen grab from ChatGPT?
Yeah, but I've heard it in a podcast too. So yeah. So I've read some estimates that the annual value of all of these cesium products is ballpark $340 million per annum.
Okay.
So it's a small market, right? And there's a lot of variability in these estimates of market size. I'm sure the only party that really knows the answer to this question is actually Sinomine. But regardless, the market it's not a huge market in terms of value. But what's more, it's pretty technical too, because there's the refining component of the various cesium products. So you got to have some technical expertise in order to turn the ore into all of those various different sort of midstream or downstream products that I talked about. The majority of the world's cesium comes from one single mine in Canada. It's called the Tanco mine. Guess who owns Tanco? Sinomine.
Oh, who would have thought?
Who would have thought? I got a picture here of what the mine looks like, and it's honestly it's kind of remarkable when you look at it. You can see these giant pillars holding up the roof of the underground there, and that's because it's actually under a lake.
Yeah, right. It's like a room and pillar jobby, but the rooms are much bigger than the bloody pillars. The harder you want to take the rib pillars out at some stage.
Yes.
That's where friggin' Sandvik ground support comes in. See the gaps there? They could just pepper it all in between the pillars.
Yes.
With Sandvik ground support just to make sure it holds up. I would propose the new Sandvik dynamic bolt. So it's normally now hear me out, it's normally for high stress environments. You think of all the boats and shit going along the lake and the tides and just the turbulent nature.
Pretty stressful.
That is a friggin' dynamic environment, and that's where this could friggin' come in. So this is perfect for the turbulent lake water at Tanco, the Sandvik dynamic bolt. Mate, these bolts have been drop tested. They've had the living shit drop tested out of them. I'll show you a video here. You can just hear the bang, like at the bloody WASM testing facility.
You know it's good.
And, mate, anything that comes out of WASM, you know it's the best. So that is, mate, they could go down the road of calling this the Dynamix bolt, as they said. I reckon we could get a better name for it, like D for dynamic. The logical name for this bolt is the Derek bolt. In honour of the great Derek Hurd, I propose the name of this is the Derek bolt. Coming out, the bloody, look at it. The paddles, the friggin' springs to mix the resin, de-bonded in the centre, the perfect Derek the dynamic bolt.
We get a petition going.
I didn't know
Derek the dynamic bolt.
The bolt innovation at this company, mate. I'm impressed.
Oh, mate. Well, there's obviously been like issues previously with dynamic bolts of the mixing of the resin. So they've put the mixing springs on the top and on the collar and the toe, because that's what Sandvik does.
It's a company that listens, mate.
Oh, mate. So, okay, after they go Are they planning to extract these pillars? Or
They actually do, like, so that, you know, these pillars are what they do really want to mine, but because there's a lake on top, their plan is to, you know, drain or divert the lake so that they can actually just open pit to access the pillars eventually. But ground support's another great alternative. I think the way that Sinomine actually got their hands on this mine is super interesting to me. Like they bought this in 2019. They paid $135 million US for the operation, and imagine paying 135 million US to get a monopoly on a critical metal. Like, it's just an amazing deal. I think this was 2019, right before the West just started to crack down on Chinese investment into critical minerals. And instead of objecting to the deal, which would certainly happen today, the Canadian regulator approved it in the minimum time frame of 45 days. But that approval didn't age particularly well, because within a few years, the Canadian government started to put the squeeze on Sinomine's ability to, you know, invest and expand. One of the orders that the Chinese government gave to Sinomine was ordering it to sell its equity stake and offtake in none other than Power Metals. That equity stake, that equity stake in Power Metals, is the very equity stake that ASX listed Winsome Resources ended up picking up. They paid $2 million for 7.5 million shares and 7.5 million warrants, which are well in the money today, and they tipped in a bit more later on. I'll get to the implications for Winsome shortly. For Power Metals, their Case Lake project has come across some high grade cesium polysite, which is what you're looking for, and it's near surface. It's decent grade, so everything's promising. But if you think of the concentrated supply of this critical metal production in the hands of the Chinese, the stocks had a really strong run, like we talked about. But it's early days, and there's plenty to play out to see if the market cap can justify the potential. But that's the nature of discoveries in our industry. You know, the share price will run, but there's uncertainty, there's upside. You're trying to find the middle ground. And with commodities that are monopolized in some part of the processing, like we do have here with the reliance on the Chinese, Power Metals, they've got their work cut out to sort of forge their own pathway. I think that's all ahead of them. But the whole thing is particularly interesting for ASX listed Winsome, because the value of their stake in the company is now valued at 48 million Australian dollars. Winsome's market cap is only $76 million, and they'll also have $34 million in cash after the raise they just did. So you can do a fully diluted EV of Winsome and back out a pretty tiny EV for that company right now, which unfortunately speaks to just the state of the lithium market.
Yeah, Jesus Christ.
Pretty negative EV, huh?
I think fully diluted, it's slightly positive, yeah.
Oh, yeah. Interesting. Tell us a bit more. I've got a few sort of questions, but I'm sure you've done a bit of digging on sources of cesium and just the kind of market in general.
So one of the claims I read when I was researching this market is there are only 3 mines globally that have ever produced cesium. Tanko being the dominant one, obviously, which I've talked about. The other 2 cesium mines are fascinating for different reasons. The first one is Bakita, which JD, you and I are a bit more familiar with after our trip to Africa. This is better known as one of the lithium mines in Zimbabwe, which has a lot of petalite, lepidolite, but also cesium polysite. And guess who owns this mine? Sinomine.
None other than Sinomine.
Of course. The other mine, possibly a surprise to you, but maybe not given what we discussed before we started recording. It's a mine called Sinclair. And Sinclair cesium deposit was discovered in 2016, delineated in 2017, then completely mined out in 2018 and early 2019.
It was Extrata, hey?
No, it was a company called Pioneer, which became Essential, which is now Develop.
Yeah.
Wow.
Yeah, right.
Yes.
Oh, Sinclair.
Deposit.
I know Burncut had a contract at Sinclair.
Yeah.
Where is the deposit?
So this is like Pioneer. It's like 60 kilometres south of Norseman.
Oh, it is. Sinclair deposit is part of Pioneer Dome.
Sinclair is. It's tiny. It's completely mined out, and obviously the market size is small as well.
Sure.
But that's where cesium was developed. Yeah,
amazing.
It was in there. It was in Develops. I think it was their quarterly or something, talking about the potential cesium deposit at Sinclair. Yeah,
I've read through the scheme docs just when I was researching this piece to see any talk of that cesium deposit and everything. But yeah, there was I didn't see anything that kind of talked about future opportunities or whatever. But who knows? There might be more to find there. But
I'd be curious to hear from
it was used to be. Was there a Sinclair nickel mine?
Maybe.
Unless it's the same fucking mine.
I'd be curious to know from any geos, given the sort of relationship with lithium type ore bodies.
Yeah, so Sinclair
yeah,
was. Where is it? Nah, it was west, 81 k's west of Leonora. That was the Sinclair nickel mine owned by Xstrata. So this is a different. Yeah, that's why.
What I did come across when I was researching this market is it's actually much harder to find than spodumene because you don't have the outcropping to go off when you're actually exploring for your cesium deposits. Very small market. But,
Fuck, we found out how easy it is to find spodumene because friggin' everyone found it.
Just wait for a price rise and get everyone looking for cesium.
We're in the predicament we're in. Sorry, it was very easy to find pegmatites. Some of them were spodumene. Dumb me ass on one that wasn't. Very good. Bloody,
really interesting.
Very interesting. Bloody, mate, old Billy mightn't have been about the lithium. Could have been the cesium.
Do you know what I think?
If it ends up going off, he'll definitely claim it. I know that.
Before this, the only use case for cesium that I knew about, and obviously it's used in oil drilling, brines, or oil drilling way more than this, but was like, the atomic clocks that are so precise. That's like on the decay of a cesium atom or something like that. That's the only time I'd ever come across cesium.
Fuck, there you go.
Wow.
I need one at home because my freaking battery keeps running out and the kids are late for school all the time because my clock's wrong. I need some cesium at home.
All our clocks are synced to them.
Right, let's go local. We've got Black Cat grabbing the Lakewood. Biggest, not the best kept bloody secret. It was in the AFR that Westgold were selling it. Black Cat have picked it up. Obviously, all the bloody, look at the tenements they got, boys. The Cal East now feeding into the postage stamp that is bloody Lakewood. Mate, I'll look at those tenements. K-Drill doesn't start with a K for no reason. It is Kalgoorlie drilling, and mate, within the proximity to Kalgoorlie, you want to drill the shit out of anything near Kalgoorlie? K-Drill. First call. Like, not even, this is like central goldfields. Like, mate.
First call, second call, last call. K-Drill.
I won't mention they'll get in trouble for mentioning that company. They're too precious. They sponsored the RIU cocktail function.
They did. I saw you had a brew with Drew.
They're now bringing the Kalgoorlie Goldfield support to Perth. Like, so they're giving back to Western Australia, give back to K-Drill by letting them, Black Cat, let them drill the shit out of all those bloody tenements out to the east there. Mate, imagine the Cal East contract. Everything they know at Paulson's is because of Ryan O'Sullivan anyway, because he drilled that back in the day.
There's a connection.
So pay back Ryan O'Sullivan by letting K-Drill drill those tenements. Anyway, let's get into the deal. That was, I think it's worst kept secret that Westgold was selling the Lakewood mill. Black Cat were the last company named in that article. They went through. There was word on the decline that Northern Star had picked it up because it's obviously abuts. So I'll bring up the picture here. It's like a postage stamp right next to the super pit waste dumps, effectively. So it'd be. Northern Star might like it to extend their waste dumps. There's word on the decline, there's an ore body under it. Like who knows? But anyway, so this is pretty bloody big news for Black Cat, and it really sets them up for the Cal East project. So because the Cal East, Black Cat was Cal East. Like that was the big that was their development pathway before Paulson's and
Coyote.
Like that was, and then that sort of got pushed to the side, and then the focus was on Paulson's. But now, and we'll go through this, and this is, doesn't a friggin' good gold price help? Like when we first talked about Black Cat, talking about the Gabbro vein mineral resource and
up
all
at Paulson's,
that, and thinking, God, it's going to be friggin' hard to mine low grade. Gold was 2,900 an ounce Aussie then, and we're now sitting at 4,600. So it's amazing how everything has changed so quickly in gold. So look, and what they've got today, and this Cal East is like, make your own judgment, but it's like there is a lot of friggin' ounces they can punch through here now. So they've picked it up off Westgold. Westgold obviously got it from the Karora deal. 85 million consideration, 70 million is in cash, staged over 9 months, and 15 million Black Cat shares at 76 cents. So they're already up on the script. So 1 million deposit, 24 mil by around 31st of March, 20 mil 30th of June, another 25 30th November this year. So they've currently got 50, because they did the big cap raise to sort of negate all the debt needed for the Paulsons refurbishment. So they had 56 mil in the kitty by the end of December quarter. So they're looking at, they've been toll treating the gold at Paddington already. They've got the JV with MMS, free ad for MMS, and bloody Saltbush are doing the haulage for it as well.
Trucking.
God, I did the 2 wrong sponsors yesterday. This has got there. So bloody God, if I'm going to give it away to anyone, I'll give it to them too. So the cash is starting to come in the door. They're mining ore at the Myrie. They've poured first gold at Paulson's. That's all starting to ramp up, and they're saying that they'll be able to, pay this off with operational cash flows. Got toll treating arrangement with Westgold, so it's a 1.2 billion tonne plant. Westgold can toll treat 200,000 tonne a year for the next 2 years. They have the option to, so potentially they can make revenue from the toll trading while Cal East ramps up if needed. Like, so you think of not that they'd do this, but hypothetically a 1.2 million tonne mill, they could toll treat at $50 a tonne. So you could bring in 60 mil revenue a year, minus all the costs, just from using that as a toll trading plan.
Yeah.
But the benefit to them now, because their gold sale, so they'll sell on the gold to Paddington, Norton Goldfields. With that, you have to agree on a grade. So there'd be top cuts and everything. You have to agree on a recovery, processing cost and everything. They now have full control, full upside to that process of bringing the gold to their plant. So obviously copping up cash for that privilege. I would imagine for that. So it's a JV in regards to the JV with MMS. So they have to, Black Cat have to first repay the development costs to MMS, which I assume is, the cost of everything to first ore. That's how I interpret development costs. Once they pay that back, Black Cat then get the next 30 mil of cash flows. And then following that, it's the JV, which I think's pretty sure is 30-70. 30% MMS, 70% Black Cat.
Profit share after that.
Yeah. So now I would assume with this, I think it's be better for both parties. They get the upside of the processing, like upside of grade, recovery and everything should generate cash quicker on a tolling arrangement because you're not paying to treat it or you're not selling it to Norton. They don't buy the gold at a loss. So it's good there. So
in Kalgoorlie.
so I'd be thinking, and the whole thing is, right, will all that cash be enough to, pay these stage payments for the year? Because it's a bit of cash going out the door this year. They've got
and to be clear,
there.
it's not that long a timeline.
No, it's
9
time.
months.
It's not production based. It's time based. So it's looking with what they've got and gold revenue coming in should be able to do it. But they're unhedged and everything. So the thing about the Lakewood thing, I mean, you've chatted about it before, is the lifespan, and that is the question. So they've just you can see here the big picture. It's on a bit of a postage stamp. They've got a brand new tailings dam there, but the exact time lifespan, I don't know. I've heard many different versions. I've heard 5. Once they've got all the lifts they've got approved, it's they've got 5 years worth of tailings they can put in there.
Yeah, it might be a bit confusing to people listening. We're not talking about the mine itself. We're talking about the lifespan of the plant because of the limited space to put your tailings.
There's nowhere else to put a tailings dam. So, and it's approved to, I think, lift, I'm not sure what it is, usually 4 lifts or something, as in pretty much build the walls high so you can put more tailings in. I've heard there's possibility of going beyond that to 9 years. I don't know if that's
There
true
was talk at the pub.
There was talk at the pub, and it might have been incentivised talk. Don't know, but 5 years. If we work on 5 years, because you look at the ground they've got around for the Cal East, there's obviously Boundary Myree, which they've got at the moment. They've got that Fingles Fortune, everything to the south. So there's, and you look at like collectively, so 1.2 million tonne mill, let's just say 1 million tonne a year. What's their and it's got a fixed lifespan. If like this is like what the direction of this company is, like hypothetically, you don't want to toll treat too much because that's taken off your ore that you want to put through in that 5 years. Let's say you've only got 5 years worth of milling to do. Because if you add up their resource, like look at Myree underground, Majestic underground, Trojan resource and Fingles open pits, that's over 5 million tonne at 1 million tonne a year. So it's like they've got enough resource at the moment to fill that mill over that time. So, but the pressure will be on, will they have enough cash flow coming in to pay that without having to, toll treat other people's dirt to bring in a bit of revenue to satisfy that. So I think that's where the balance of what their journey is going to be to get all these things into production, make the cash flow, because they don't want to, you don't want to get into a place like shit, we can't use the mill anymore in 5 years' time.
When you toll treat,
or if it goes to 9 years, it's all good.
When you toll treat, are they toll treating contracts typically structured as like a dollar per ton of ore, or do you get some of the upside of the? Because let's say if they were toll trading stuff that was 3 times the grade of theirs, and they're getting a share of the upside in that person's ore, then it actually does make sense to prioritize someone else's ore if it's 3 times the grade.
Depends if it's a ore purchase agreement, if they're
on the terms,
Yeah, so I'll bring up Westgold's and New Murchison's one. I think it's at the bottom. Ding, ding, ding for LGC there. So I think it works out effectively like they have to pay $30 to $45 of processing costs per tonne, which gets taken off the gold price and all that. So it works out I think New Murchison get 83% of the gold price. But if the gold price is high, as you said, they're getting more bang for buck out of Westgold are getting more bang for buck out of the 17%. The 17% of a higher gold price is worth more. So that's for an ore purchase agreement. If it's a toll treating agreement, it might be, we'll send you all the ore, it's friggin' we campaign it and we'll charge you $50 a tonne and you get the gold out. So they're stopping all their ore, but they're treating your ore all in one parcel. Yeah. So, $50 a tonne for a whole year, there's 60 mil of revenue.
Yeah.
So,
all depends how you structure it.
I wouldn't, depending on price, or this would be a thumb suck, but I would imagine you would make more money long term treating all of your own ore instead of having an arrangement with another company for their ore.
Yeah, and the value of the infrastructure, even though it's got the limited lifespan, I'm pretty sure the dynamics in Kalgoorlie at the moment are okay, where else can you toll treat ore? If you a lot of random projects are suddenly in the money, right?
Yep.
As long as you can get it processed at a mill somewhere that is economic to truck to. Well, it's in a good location, plenty of things are truckable to it, and capacity at mills you can actually toll treat at close to zero. People have been doing it at Paddington, mate. That's because FMR, which is typically where you go to toll treat, fucking booked out by Northern Star.
Yeah.
So,
and then I suppose there's, typical supply and demand. It mightn't be, if there's nowhere to put it, people might pay $60 or $70 a tonne. I'm not sure of the numbers.
Totally. Yeah.
So they might sacrifice production later on and take a bit of sugar hit. But then it'd be interesting to see as the KCGM expansion ramps up how that supply demand
unlock some capacity maybe.
Yeah, and then if that, imagine if someone then picks up Canaan and Bell, that gets taken out of Northern Star, and then so I think there's a lot of there's a journey of processing to happen in and around Kalgoorlie.
There's lots of expansions happening too. Yeah,
and
Evolution's still expanding, and Zijin's massively expanding.
Silver. I think Silver Lake have got a pretty big between the stockpiles and all the pits they're bringing on. Mount Munga's probably got a bit of life there. Does that come into the mix? Does Jubilee get refurbished by someone? Does Northern Star get rid of that? we should just do a mill episode. Oh, Stoitis is on a board now. He probably can't do podcasts.
There's a lot of deals to be done in the area.
Stoitis, who's someone like you that's not on a board that could come and talk shit on a podcast? Let us know. So I think that whole, I think it's given them a bit of power in the district, like on a smaller scale, like being able to, hold the keys to processing, who's going to process what. Like there's obviously got a lot of resource areas to develop out at Cal East there. So, it's really fucking looks like a bit going on there.
Yeah, and hence Westgold retaining that optionality, just getting the first priority in case they want it, that 200,000 ounce per annum. Yeah. Smart thing to do if you're the seller. Yeah, sorry, 200,000 tonnes per annum.
And I suppose it shows, like, what's this mean for Westgold? You could infer that, okay, they didn't have enough dirt to fill both Higginsville and Lakewood at the moment. I reckon it's a win-win-win. Great for them because they're like, bloody, they get 70 mil cash within the year and they're already up on the bloody Black Cat shares, which are escrowed for 12 months. Pardon me, they can roll that into expanding Higginsville. They were talking about expanding Higginsville. Why is that?
Well, for a period of time, they'd switched off their open pits in the Southern Goldfields region, Westgold, and now they're coming back on. So, like, to the extent they were feed constrained, maybe that was a temporary thing because you didn't have the open pit feed. Yeah. To your point, it's all about.
It makes sense that, like, is Pantoro going to be on the radar for Westgold to make more out of that region?
Non-deal roadshow just happened.
Non-deal roadshow, if they expand to 4 million tonne, will Astral, like they got, get 1 to 2 million tonne out of that a year. Once that pit gets flying, probably like that could be the supplement. They could really start consolidating that region. So it'll be interesting to see what if they'll just keep. I suppose, would you say in history sometimes, like when the companies are down, it's like, right, we may as well just keep bloody pumping script and do deals and set ourselves up for the future. Who knows? Who knows if that's going to be Westgold's mentality? So I can't. But yeah, getting Beta Hunt going. That's
getting bigger has been part of the MO for a while now.
And it's good. I didn't realise how it's pretty deep mine. And,
you were saying down at Beta Hunt, Fletcher, where they're punching holes in.
Yeah, I did not realise how deep it was, but there is some freaking high pockets of high grade there if they can make it bloody happen. So yeah, bit going on. So bloody, what's Black Cat's $500 million company now?
A lot has changed in the last 18 months, hasn't it?
Yeah, so there's going to be a bit going on there. Yes, so there we go. I love talking about gold.
More deals to come, Matty. I think that's the way to sign off on that one.
Oh, mate, that's the thing. Like everyone's saying, all the pits are being mined. We have to go deeper for gold. Not the case because all the pits were mined that were economic. There's frigging gold everywhere.
Couldn't have said it better, mate.
It's just a different grade now. Righto. Speaking of making Black Cat better, Mineral Mining Services. MMS.
They are.
Oh, mate, they're going to be the cash will be coming in for them soon. Grounded Construction Group. Sandvik Ground Support, taking advantage of the cesium mayhem. And CRE Insurance. That joint looked like probably needs insurance once they rip those pillars out. Cadron. Repelling Black Cat. Saltbush Contracting. They're already hauling to Paddington. Now they'll be hauling to Lakewood. Swick. 17 million metres, that's all I have to say. Quattro Project Engineering, could do a bit of refurb on the Lakewood if needed. Call Quattro. Cross Boundary Energy. Oh no, they'd have to be downloaded out there somewhere. And get your bloody underground operators tickets. $100 off. Link in the show notes. Hooteroo Money Miners.
Go Australia.
Gosh, go Kalgoorlie.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.